Well, good morning, everyone. Thank you for joining us for our quarterly medalist webinar. Today, we'll be going through positioning portfolios through change. My name's Michael Mulseed. I'm Head of Institutional Portfolio Management.
G'day, my name's Matt Wilkinson, Associate Portfolio Manager.
In terms of just housekeeping for today, so this is an accredited session, so you will receive CPD points via email. Please enter any questions through the Q&A function on Zoom, and please you'll get a feedback survey after the session where you can provide your feedback, and we really value that for putting together these sessions that can be useful to you in the future. This session is also being recorded and we'll send a copy to all participants. Just the obligatory disclaimer you can read at your leisure. In terms of an agenda today, on the next slide, so we'll just give a little bit of an overview of our medalist offering. It's one of our managed account solutions at Morningstar. We'll give an economic update, talk through some of the performance drivers of the market and the portfolio, and also an update to what we're doing with the portfolio and how it's positioned going forward. So just firstly, wanted to kick off with a bit of an overview of Morningstar in the managed account space and what sets us apart. Basically, there's three key pillars, which is our customer value proposition at Morningstar Investment Management. So one is our heritage. We have a very long track record of managing money in Australia in managed accounts. We've got a 20-year track record on this space. We've been doing investment consulting, capital markets research for institutional clients for 30 years, and Morningstar as a business was founded just over 40 years ago. So we've been in it for the long term, and we certainly have the pedigree and track record in this space. Second is just around our investment capabilities. So we're plugging this medalist process into our investment capability that manages money for institutional clients. So it really is premium investment grade, and it covers off on all of the compliance, regulation, governance aspects that are really important for you and your clients in having confidence in these portfolios. And thirdly, and not least, is just around our service and support model. So we really pride ourselves in providing a premium level of support to you and your clients that you can be really armed with all the information that you need to be able to use these products with your clients. And at the end of this presentation, we'll show you the team that we have behind this that you can talk to and get more information. Just in terms of where Medalist fits on our managed account solution, so across the bottom is our range of product suites. So on the left-hand side, the two multi-asset SMAs and managed funds, they're Morningstar branded products. They use Morningstar IP. They build portfolios from the stock level up or using Morningstar funds. And then to the right of the centre, we've got our third-party manager managed accounts. So that's using third-party medalist rated funds for the Morningstar medalist portfolios. And then we've also got our outsourced chief investment officer, which can be a blend of the two. And we do custom portfolios for larger clients that need that solution. But importantly, all of these products have come with all of the benefits of managed accounts in terms of providing efficiency for your practice, outsourcing that investment function to a professional manager, having that strong level of governance and compliance that you can have confidence in, and really focus on the client service and strategy aspect of your business, which is certainly, we're seeing a lot of traction in the market with advisors adopting this model. In terms of the medalist process, just a little bit of an overview. So working from the bottom of this slide up in terms of how we form the portfolios. So they're formed on the bedrock of our strategic asset allocation at Morningstar. That's using Morningstar's long-term capital market assumptions. We use this for all of our big institutional clients, including superannuation funds use this sort of research. So it is very well regarded and widely used. Secondly, in terms of active-passive optimization, we look to get efficiency in the portfolio through using passive where it doesn't necessarily make sense to use active, where there's not a high alpha opportunity, but we are willing to pay active fees where we think there is alpha. So that ensures that the product is priced at a point that is competitive in the market and likely to generate good net of fee returns. Thirdly, is just that manager selection piece. So the medalist portfolios has the investment universe of Morningstar medal rated funds. So the gold, silver, or bronze rated funds by Manager Research. Manager Research sit independently to us. They're that additional layer of filter to the portfolios and ensures that we're only investing in the best and most scrutinised managers in this third-party manager portfolio. Next up the list is we do active asset allocation tilts. So we're benchmark aware in the sense that we don't deviate very broadly from our asset allocation, but we will tilt in and out of asset classes where we see opportunities, and we'll go into that a little bit more in the presentation. And then lastly on that list is just in terms of risk management and portfolio construction. Again, we're using all the tools that we use for institutional clients to ensure that the portfolios are managed within their risk tolerances, and all of the pre and post trade compliance checks are done on these. That's an overview of the product. I might now turn to Matt just to give a bit of a market update.
Thanks, Mike. It's been an interesting quarter from a couple of different perspectives, and we'll just talk to the US at the moment. Now, unemployment rate is ticking up. There is a little bit of pressure to the unemployment rate, and that is certainly something that the US Federal Reserve are watching closely. Inflation has come down, but it's still higher than the target of 2%, currently sitting at 3% as of the last print in September. The budget deficit, as has been the case for quite some time, particularly since COVID, is sitting higher than it otherwise would. That doesn't look to be changing anytime soon. Not really a day-to-day watch point, but something that I think the market has at the back of its mind. And it certainly comes to the fore occasionally, and you'll see it written about in the press from time to time. But the market is currently pricing in a cut of 25 basis points at the next Federal Reserve meeting next week. So I think that's sitting at about 85 to 90% of probability according to market pricing right now. So worth keeping that in mind when we talk to Australian economics in a moment. Just on China, growth there reasonably, just sort of ticking along reasonably subdued, sort of 1.1. Inflation is quite low, and unemployment there it's sitting at 5.1. And just a note on the debt to GDP there, just as a comparison compared to the US. Turning to Australia, now the RBA has cut several times this year, 3 times from 4.35 to 3.6, and the market has now just recently repriced future rate cuts. So we had a recent trim mean of 3.3. That's outside the 2 to 3% band that the RBA targets. Our GDP growth is sitting at 1.8. However, so it's not extreme and it's not too low. It's probably acceptable. Wage price, again, kind of a derivative or a cousin to inflation, is sitting at 3.4. So, reasonably healthy wage growth from the Q3 print. And government bond yields, and this was taken from very earlier today actually, the 10-year yield is sitting at 4.6%. Now that's quite a significant rise from last quarter, where it was close to the low 4s. So there's been a bit of a rise there, and again, I think it's worth noting that the US and Australian sort of economic and inflation environment have headed in slightly different directions, and we'll just wait to see sort of how that plays out. Certainly the bond yields, the 10-year yields between Australia and the US are generally quite tight and often rhyme in terms of their movement, but certainly the difference between the two yields have stretched more recently. From an economic risk perspective, some of these points have been around for a little while, but still relevant. the spend in AI is a big, sort of a big market sort of watch point. The hyperscalers spending on AI chips, for instance, and building out their data centers is the amount of money they're spending there is astronomical and is very much being watched by the market. Can that last? US tariffs are slowly seeping through, and corporates are digesting how they recoup some of that money if they can, in terms of raising prices, trying to cut costs, or actually absorbing that in terms of profit margin. That leads to the third point: can profit margins be sustained, and what's the consumer ramifications from those tariffs? Again, those points have been around for a while, but we think that's still playing out to some degree. The last point is about credit spreads. They have been very tight, and in fact at all-time tights broadly since for the last few months. Should those spreads widen quickly, that will be a repricing of credit spreads, of credit, and what that might mean for markets. But all in all, just probably so those 4 points are a reasonable summary of where we're seeing sort of primary risks out there in the market. From a valuation perspective, this is one lens. The US is obviously appearing quite expensive at 23.3 times in the blue line. Emerging markets down at 14 times. But worth noting that the baseline and the expected price to equity value is always going to be different between those two. Matter of fact, we think emerging markets are more attractive at an absolute and a relative basis versus the US market overall. But worth noting, the US is certainly towards the upper end of its more recent band. However, prices and PE ratios are only as relevant in terms of what's the underlying growth rate. Growth is actually and this is what we measure, how we measure that metric, from a price equity growth ratio. And this is what we're seeing right now, 1.3 times. So actually, based on the expected growth rate, those PE ratios don't look too bad. The latest result is actually sitting right on the historical average there. So that's important context to note. Let's move to the portfolios now and just talk about, move to the markets and talk about what's driving portfolio returns. And so these are the year-to-date returns from the major sort of areas of the market. First up across equities. And across the US, whether it be the S&P 500, large cap growth, value, the returns have been very strong. All these bars are obviously green, and the S&P 500 doing 17.4%, virtually in the first 10 months of the year is a very strong number. And frankly, that's expecting that going forward on a year-on-year basis is probably a bit of a stretch. But investors should be very happy with the kind of returns that they've had over the last 10 months. Even ACWI returns ex-US, so outside of the US, returns have been even stronger. Again, some of our portfolios have been tilted in their global equity exposure away from the US because we've seen that value, and a 28 to 30 something return across US and across ex-US and emerging markets has been a very healthy return indeed. That sort of third group, that cluster of green bars down the bottom, bonds and fixed income in general. So across all segments, all sectors of fixed income, returns have been very strong. Again, some of the high yield and corporate bond returns have, at 7 and 7.4%, are very strong, probably slightly outsized returns and driven somewhat by credit spreads as well. Credit spreads tightening, that is. In terms of sectors, ACWI sectors year to date, what have we seen? The communication services and technology on the left, again, massive returns. We know what's been happening across, tech sectors. I think that's been a trend for the last couple of years. The law of large numbers says that there's going to be a headwind to maintaining that level of growth, but it's certainly been spectacular growth over the last few years and particularly year to date as well. Utilities has been a very interesting one. That's the third bar in from the left, coming in just under 20% there. And again, many of the utilities across the US are very much linked to the technology and AI boom as they build out data centers, and those data centers have a large requirement for power. So there's a link there, and investors have sort of chased that sort of second order theme to building out those data centers and the AI theme. Down the other end of the chart there is consumer staples, real estate, healthcare. Again, the numbers are what they are, but naturally those areas are actually showing up, or at least in our perspective, are showing up as some of the better valued sectors of the market, particularly healthcare and to a slightly lesser extent consumer staples as well. So I think that's a good reflection on sort of the concentration of the market and what's been driving different areas across people's portfolios. We've had a little bit of volatility recently, and I thought it's worth just bringing up just the reasons to stay invested and to maintain, an exposure to the market. Trying to be cute, trying to really time things generally just spells disaster or at least a loss in return overall. And so I've brought up this chart, and it's showing the effect of missing some of the best days over the last 25 years with an initial investment of $1,000 using the S&P 500. If you stay fully invested, that $1,000 has turned into more than $6,500. And if you miss the best days, that return actually falls down to almost $6,900. If you miss the best day, that is. If you miss the 5 best days, the number drops even further. Miss the 40 best days all the way down to the end there, and that's what happens. So you don't actually know when those days are going to come. The volatility is natural in markets. Does give you an opportunity to, as investors, for us to rebalance, but we are staying in the market, and it just shows that if you try and get too cute about things, I think it's more often than not a detriment to investor portfolios. Another sort of chart to that effect, and look, just showing if you're trying to exit, and it's a timing sort of chart and the effect of timing. If you're starting to exit after 2 weeks and you stay out for these kinds of periods, 1 week, 2 weeks, 1 month, etc., what happens to the value of the portfolio? And it's pretty clear again that that time in the market does not work from these charts. So the Miller's portfolio series covers the Miller's core portfolios themselves, the multi-sector series, our first choice, core and our core and active portfolios. The returns have been, quite, very good over, annualized sort of 2-year periods for most of or for the length of the Medalist portfolios. From an absolute return perspective, been very strong. Performance has been very strong relative to other SMAs. running similar styles of portfolios using third-party managers. So we're very happy about that. 3-year numbers for First Choice and multi-sector series are also holding up very well. Bearing in mind that some of those longer-term histories have had part of the COVID and post-COVID volatility in them as well. So I think what this is showing is that the breadth of managers that we're using and the diversification that we're able to achieve from those managers and blending those managers in the right way is coming through in a very stable and consistent return profile. Okay, I'll pass to Mike. Yep.
Yeah, thanks, Matt. In terms of a portfolio update, we just wanted to give some context around how we think about portfolio structure, and we have made some changes in the last few months with manager changes to make sure that the portfolio structure is exactly where we want it to be on a look-forward basis to maximise those risk-adjusted returns going forward. So the analogy we sort of talk about or have talked about with clients before is managing these portfolios is a little bit like being a football coach managing players on a field, and those players on the field are the individual managers. So the graphic on the right shows how we might think about the growth side of a portfolio being, the side of the portfolio you want to generate returns, want them kicking goals. And different managers, different asset classes, different styles will be different positions on the field, and we want to have spread on the field. So regardless of market conditions, sometimes growth is in favour, sometimes value is in favour. We have managers that can perform in those environments, and the portfolio is not just captive to one particular theme. It's not a portfolio that's only going to perform in one type of environment and then miss a trick when the environment changes. So the graphic on the left is actually the Morningstar risk factor model in direct. So that's the more quantitative mathematical way of looking at these things when we're doing risk analysis. So our 6 risk factors that we call out there is style, growth or value, yield, exposure, momentum, quality, volatility, liquidity, and size. And each coloured dot there is a manager represented in the portfolio, and the black dot in the middle of the bar is where the index sits for equities, for global equities in particular in this instance. So you can see there's a spread of dots from growth to value, from size being large to small. There's a spread in volatility, and that's what we want to see when we're thinking about putting managers together. Now, when we've looked at the portfolio, or we continue to monitor the portfolio and the roles that each manager plays in that portfolio, one of the key things we do is look to see that they are continuing to stay true to the label of why we put them in there. That involves actually looking at their portfolio holdings, the consistency of the style that they're holding, their activities. So if we move to the next slide, a couple of the changes that we've made in the last few months has been really just around our core managers in global equities and in Australian equities. That's the sort of that midfield positioning on the football analogy, if you like, that are going to deliver returns that are commensurate with the benchmark returns and add a little bit of incremental alpha over the top of that without taking a lot of risk. So MFS Global Equity was a manager that we held in global equities, and Fidelity Australian Equities in Australian equities were 2 of those managers that initially were in there to play that role. But over time, as the market concentrations increased in global equities in particular, we've seen that these managers have moved away from that core function. And so when assessing the portfolio, who do we need in that position going forward for the best possible outcome? We've selected a couple of new managers that we're really excited about and added to the portfolio, and those are Lifecycle Global Share for global equities and Solaris Core Australian Equity for Australian equities. Now, these are very strong core managers. They're very consistent in terms of their process. And we've got a lot of confidence and conviction in these managers that they can be delivering this strong core to the portfolio. We want them sort of hitting singles in the portfolio, not swinging for the fences, which is important. We've got other managers to play that role in the portfolio. And the other big upside to these managers is the fee structure. So Lifecycle Global Share is at 36 basis points. That compares to MFS at 68 basis points. So it is a lot cheap, a lot more attractively priced. They're a new entrant to the market. So that's a good aspect to that. And then Solaris Australian Core Equity, it's listed here at 0 basis points. It's a fee. They don't charge a management fee unless they outperform, and then they charge a performance fee on performance over the benchmark. So they're only going to be charging a fee when they outperform, and if they don't outperform, there's no fee to the client. So that's a good trade-off in the sense if they do outperform, you will be paying a fee, but you're only paying for that outperformance. And when we're looking at that sort of active-passive optimization, this is a good solution for a core Australian equity manager. And then the next slide is just in terms of our current positioning. If we think about that total portfolio, when we blend the managers together, what does that look like? So in terms of growth defensive split, so we're about equal weight or neutral in terms of growth and defensive assets across the risk profile. In fixed income, we've got a little bit of an overweight to core bonds, but an equal weight to sort of interest rate duration using a blend of active and passive, some more sort of active credit managers around a core bond core. In Australian equities, so turning to that growth side of the portfolio, even though we're equal weight growth broadly, where we've got a bias to global equities over Australian equities, that's pretty consistent across all of Morningstar's multi-asset products, just because we see that there's better diversification globally. The Australian market is reasonably fully priced and very concentrated in those financials names, those banks that are trading quite expensively. So in terms of risk reward, we think there's better opportunities offshore. And if you're looking outside of the US, which is that expensive market, as Matt showed with those valuation charts earlier, there are opportunities outside of the US, so you get more diversification and better valuation opportunities. And we're playing that through exposures to managers like Barrow Hanley, which will have more of a European equities exposure than a US exposure. Within Australia, a bit of the offense that we're playing, we do have an allocation to small caps through DNR emerging companies, and that's been a very good manager. So that's differentiated to the large cap index, and we think will add incremental alpha. In terms of the core manager, we now got Solaris in the middle there. On the offense, we've got Platypus, which is a growth manager. They've had a bit of volatility recently. It's the type of manager they are, trying to hit more boundaries. So sometimes they'll miss and you'll have a bit more volatility. So we weight that appropriately, but do have conviction that over the medium to longer term, they are going to be delivering healthy alpha outcomes, and certainly they have a track record of doing that. And then on the defensive side, we've got Schroders, which is more of a value play in Australian equities. Then in terms of global equities, so we do have that underweight to sort of tech and that AI theme. That's a function of it's very expensive. The managers that we own, active managers, are typically seeing that it's expensive and looking at better valuation opportunities elsewhere. So there is a bit of a natural underweight. We do manage the underweight through our exposure to the S&P 500 ETF, so that we're not too underweight the US and not too underweight the technology names. We also recently added the Qual ETF, which it gives us a little bit more exposure there. But on a total portfolio level, we are still underweight, which means that during periods like what we've seen, in the last few weeks, and we saw it earlier in the year, when there's volatility in the market, the portfolios generally do exhibit good defensive traits. So it gives us confidence that there's a margin of safety in the portfolio, and if we have a sort of a big drawdown, we'd like to see the portfolio outperforming the market. And certainly we saw that in the last month where the market did draw down and the portfolios outperformed. In terms of currency exposure, so we run the hedging around 45%. That's the benchmark. But sort of net would be have a decent underweight in the US dollar and an overweight in that EU and UK currencies because of the underlying manager exposures. In terms of just the availability of the product, so it's available across a very broad suite of platforms. So certainly there's lots of access points for it depending on your preference or your current platform relationships. And then just on the next slide is I mentioned earlier around our customer service support for you and your practice. This is our team, very well resourced. You should be familiar with some of these names and feel free to reach out to them for more information. We do have time for open for Q&A, but I don't see any questions that have been entered into the chat. So, and we are up against 11:30. So unless there's any questions that come through.
This might be the first time that we've actually finished. Only a little bit late, I think, Mike.
So yeah, thank you very much for your time. I did just want to note, might have come on your screen, just give you a reminder that registrations are now open for the Morningstar Investment Conference for 2026. So that's our big flagship event next year. So please look out for links to register for that and get on board early. It would be great to see you there.
Thanks, everyone. Thanks for dialing in.
Thanks for your time.
Any advice in this video is general advice prepared by Morningstar without reference to your objectives, financial situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.